Two Palantir income ETFs walk into the examination room carrying triple-digit headline yields. One uses weekly leverage, the other runs a synthetic covered call strategy. Both have delivered enormous piles of cash. Both have also suffered severe damage beneath the payout. That is the trap we are dissecting today. PLTW and PLTY can make an investor feel rich every Friday, while the capital underneath tells a much less glamorous story. But these funds are not identical disasters wearing different ticker symbols. One has produced a dramatically stronger all-in result. The other has a slightly larger advertised yield. Their income engines behave differently, their upside trade-offs differ, and their distribution trends reveal very different levels of distress. So we are not asking which ticker produces the loudest yield. We are asking the question that actually matters. After the distributions arrive and the fund's value moves, what did the entire machine leave behind? In one corner is the Roundhill PLTR Weekly Pay ETF, ticker PLTW. It launched on February 19, 2025, has $115 million in assets under management, and charges a 0.99% expense ratio. Its category is trading miscellaneous, which is an appropriately broad label for something built less like a conventional stock fund and more like a highly tuned Palantir trading vehicle. PLTW seeks weekly distributions while targeting 1-2 times leveraged exposure to Palantir's weekly price return. The word weekly matters. This is not simply a promise to deliver 1-2 times Palantir over any period you choose. The exposure is managed around the stock's weekly movement, so the path Palantir takes can influence the outcome. A smooth climb, a violent zigzag, and a sharp reversal can produce different experiences even if they eventually reach a similar destination. Under the hood, PLTW reports a Palantir Technologies Inc. weekly pay swap NM position at 99%, United States Treasury bills at 83%, and Palantir Technologies Inc., ticker PLTR, at 20%. Those percentages should not be read like slices of an ordinary pie. The swap creates derivative exposure, the Treasury bills help support and collateralize the structure, and the direct stock position adds actual Palantir ownership. The overlapping exposures are part of how the fund builds a leveraged package rather than a plain basket of stocks. In ordinary English, PLTW is trying to ride Palantir with an engine that runs hotter than direct ownership, while converting part of the strategy into weekly cash. That can amplify participation when the weekly path cooperates, but leverage is not a free turbocharger. It can magnify adverse movement, increase path dependence, and leave the fund rebuilding from a smaller capital base after a severe decline. The weekly payout is the visible exhaust. The swap, stock exposure, collateral, and active management are the machinery producing it. In the other corner is the Yield Max PLTR Option Income Strategy ETF, ticker PLTY. It launched on October 7, 2024, has $343 million in assets under management, and charges a 1% expense ratio. Its category is derivative income, which tells you immediately that this is an income strategy built from financial contracts, rather than a simple Palantir shareholding. PLTY reports United States Treasury bills at 99%, a cash offset at 4%, and the First American Government Obligations Fund, ticker FGXXX, at 3%, plus 3 call options the fund rates for premium income. Again, this is not a normal stock portfolio. The Treasury bills and cash-like positions provide collateral. The derivatives create synthetic exposure to Palantir and support the covered call strategy. Here is the plain English version. PLTY builds a financial stand-in for Palantir exposure, then writes call options around that exposure. The option buyer pays PLTY a premium. That premium helps fund the distributions. In exchange, PLTY gives away part of the upside if Palantir surges beyond the terms of the calls it sold. It is like collecting a fee today for promising someone else part of tomorrow's celebration. If Palantir is flat, choppy, or rises within a favorable range, that premium can be useful. If Palantir launches upward, the option obligations can prevent PLTY from capturing the full move. If Palantir falls, the premium provides only a limited cushion. It does not make the downside disappear. That is the central strategic difference. PLTW is the leveraged participant, using a swap, collateral, and direct shares to pursue a hotter weekly version of Palantir's price action while making weekly payments. PLTY is the option merchant, using a synthetic covered call structure to sell portions of Palantir's potential upside in exchange for current premium income. One pushes harder on the accelerator, the other rents out part of the engine's horsepower. Neither structure creates free money. PLTW can suffer from leverage, adverse weekly paths, and capital damage. PLTY can lag badly during explosive upside because gains are capped by the calls. In both cases, a distribution may come from option economics, trading results, income, gains, or return of capital depending on what the fund documents report. A large payment does not automatically represent newly created wealth. Sometimes cash is merely moving from inside the wrapper to the investor's account. The cost comparison is close, with PLTW carrying the lower stated expense ratio and PLTY the higher one. PLTY is the larger fund by assets under management. Neither fact settles the matchup, but both matter. Expenses continuously pull against performance, while fund size can affect how established and widely used a product is. The decisive issue, however, is still what each strategy has done to the combination of income and capital. This is educational research, not financial, investment, tax, or legal advice. It is not a recommendation to buy, sell, or hold PLTW, PLTY, Palantir, or any other security. ETFs can lose value, and complex derivative or leverage strategies can behave differently from what an investor expects. Distribution policies, portfolio positions, option exposures, tax character, and fund risks can change. Verify the current prospectus, shareholder reports, distribution notices, and other official fund documents, and consult a qualified professional who understands your circumstances before making any decision. Now we examine the number designed to make both funds irresistible at first glance. PLTW carries a headline distribution yield of 138%. PLTY carries a headline distribution yield of 121%. Both pay weekly. On the billboard, PLTW is the louder offer. But a distribution yield is not a guaranteed return, and it is not the same thing as earning that percentage while preserving the original investment. The yield is calculated against a changing fund value. If the denominator falls, the quoted percentage can look spectacular even while the investor's capital base is deteriorating. A smaller house can make the rent look enormous as a percentage of the property's current value. That does not mean the owner is wealthier than before the walls started disappearing. PLTW has delivered $34.24 per share in cash distributions since launch. PLTY has delivered $75.62 per share. Those figures confirm that the payouts were not imaginary. Actual cash left each fund and reached shareholders. PLTY's cumulative amount is larger, though its earlier launch gave it a longer period in which to distribute cash. The important distinction is between cash flow and economic gain. A weekly payment can be useful to someone who deliberately wants frequent cash, but the payment does not reveal whether the fund earned enough to replace what it distributed. If the strategy sends out cash while the underlying capital falls, the investor may be receiving part of the investment back in installments. PLTW's yield is supported by a leveraged Palantir trading structure. PLTY's is supported by monetizing option premiums and accepting capped upside. That makes the headline comparison less like choosing between savings accounts and more like comparing two businesses with different ways of selling future participation. PLTW advertises the higher current yield, but it asks investors to tolerate the hazards of a leveraged weekly target. PLTY advertises the lower of these two extraordinary yields, but it finances the payout partly by surrendering potential gains through its call writing program. The yield contest, therefore, has no honest winner in isolation. The bigger number only tells us which siren is singing louder. It does not tell us which ship survived the voyage. Next comes net asset value, the per-share value of what remains inside each fund after its assets and liabilities are accounted for. PLTW's launch reference price was $41.99. Its latest NAV is $17.18. Its NAV return since inception is negative 59%. That is major capital impairment. An investor who focused only on the weekly deposits could miss that the fund unit generating those deposits became much less valuable. PLTY's launch reference price was $51.75. Its latest NAV is $28.64. Its NAV return since inception is negative 45%. That is also severe damage, but PLTY held up better on this measure. Its share value still suffered a large decline. It simply retained more of its starting value than PLTW did. The comparison exposes what headline yield hides. PLTW's leverage construction can be especially punishing when Palantir's weekly path and the fund's exposure do not cooperate. Once NAV falls, recovery becomes more demanding because future gains start from a smaller base. A fund can continue mailing cash while the economic platform supporting those payments gets narrower. PLTY faces a different structural pressure. Its call premiums can provide income, but selling upside means the fund may not fully participate when Palantir rallies sharply. That can make rebuilding NAV difficult. The fund accepts cash now, but the price of that cash may be reduced access to the very gains that could repair earlier losses. This is why an options income fund tied to an aggressive stock can produce a frustrating pattern. The stock can fall and pull the strategy down, while a later rebound may be partially surrendered through sold calls. The premium softens some blows, but the ceiling can interfere with the climb back. Between these two patients, PLTY has the healthier NAV record. Healthier is relative, not flattering. A negative 45% NAV return does not become benign because another fund posted negative 59%. It means PLTY preserved capital better in this head-to-head, while both demonstrated that weekly cash can coexist with substantial deterioration in the value of each share. If an investor needs to sell, rebalance, or pass the position to someone else, NAV is no side note. It is the remaining body of the investment. Income deposited yesterday cannot make today's lower share value irrelevant. The complete experience includes both. Now we reunite the cash with the capital and examine the simple distribution inclusive result. PLTW's simple distribution inclusive return since launch is 22%. Despite its severe NAV decline, the accumulated cash payments were large enough to leave this measure positive. That is an important correction to any claim that PLTW's entire history has been a complete loss. The fund damaged capital dramatically, but its distributions changed the final arithmetic. PLTY's simple distribution inclusive return since launch is 101%. On this measure, PLTY is far ahead. Its combination of cash distributions and remaining value produced a much stronger result than PLTW's combination did. This is where the matchup becomes more interesting than a funeral for two shrinking share prices. PLTY did not merely distribute more cash while starting earlier. According to the supplied simple calculation, it left the investor with an all-in result that substantially exceeded the original reference amount. The NAV chart alone would fail to capture that. At the same time, the result should not be confused with a smooth or low-risk journey. A strong distribution-inclusive outcome can coexist with a damaged share price, violent drawdowns, and a payout stream that changes over time. An investor who spent every distribution would have experienced the position differently from one who reinvested. Taxes, timing, market prices, and personal cash flows can also make an individual experience differ from this simple comparison. But we do not need to manufacture additional calculations to see the main result. PLTW demonstrates why cash distributions must be counted before pronouncing a strategy dead. PLTY demonstrates why NAV decline by itself does not equal total loss. Yet the gap between them is decisive within the supplied data. PLTY produced the stronger all-in record, while PLTW's positive outcome came with a much weaker ratio of reward to visible capital damage. This beat also clarifies the purpose of an autopsy. We are not judging a fund by whether the chart points upward or whether the account spits out cash. We examine the whole organism. PLTW's income rescued its result from the appearance created by its NAV collapse. PLTY's income did considerably more than that, but neither all-in figure guarantees that the same strategy, payout, or market environment will continue. Risk is where the weekly payment schedule stops feeling comforting and starts feeling cosmetic. PLTW's maximum drawdown was negative 74%. PLTY's was negative 72%. PLTY held up slightly better, but that is not a meaningful safety mode. Both funds experienced losses deep enough to test whether an investor truly understood the machinery before entering. A drawdown of this scale creates more than a mathematical problem. It creates a behavioral one. Weekly cash can encourage an investor to remain calm, but it can also obscure the severity of what is happening. The account keeps producing deposits, so the strategy feels functional even while the position's value is being heavily compressed. The distribution trend adds another warning. PLTW's first 4 distributions averaged 32 cents. Its latest 4 averaged 18 cents. The latest average is 56% of the first average. The payments remain substantial enough to attract attention, but the direction is clearly lower. Anyone building a household budget around the opening payout level would have discovered that weekly describes frequency, not stability. PLTY's decline is far more extreme. Its first 4 distributions averaged 303 cents. Its latest 4 averaged 28 cents. The latest average is only 9% of the first average. That is not ordinary wobble. It is a collapse in the average payment compared with the fund's opening stretch. This creates the most revealing split in the entire comparison. PLTY delivered the stronger distribution-inclusive result and preserved NAV better, but its payout trend deteriorated much more sharply. PLTW produced the weaker all-in result and the deeper drawdown, yet its latest payment average retained a larger portion of its opening level. That does not make PLTW's distribution dependable. It means the forms of distress are different. PLTW shows more severe capital damage and a weaker total outcome. PLTY shows a more successful historical extraction of cash, followed by a much more dramatic reduction in the average amount being distributed. The underlying Palantir relationship also matters. A strategy linked to one volatile company inherits concentration risk. Company-specific news, valuation changes, earnings reactions, and abrupt sentiment shifts can dominate the fund. PLTW adds leverage and weekly path sensitivity to that concentration. PLTY adds option timing and capped upside risk. Neither offers the diversification most people associate with the word ETF. PLTW can be hurt when leveraged exposure magnifies an adverse move or when volatility creates an unfavorable sequence of weekly results. PLTY can be hurt when Palantir falls beyond the protection offered by collected premiums, or when it rallies so strongly that sold calls surrender valuable upside. One can get punished for pressing the bet harder. The other can get punished for selling away too much of a winning move. The practical risk is therefore not merely that the quoted yield changes. It is that the fund's entire economic bargain can shift while the ticker and weekly schedule remain the same. A shrinking distribution, lower NAV, and a concentrated derivative strategy can leave an investor holding a very different income tool from the one originally imagined. PLTW's assigned verdict is on life support. The payout increasingly comes at the expense of capital or is being cut. That label follows the supplied evidence. Its distribution-inclusive result is plus 22%, so this is not a cause of death case. Cash distributions mattered and left the simple all-in result positive. But its price and NAV result alone is negative 59%, and its latest 4 distribution average is 56% of the first 4 average. The patient is still producing cash, but the capital base has suffered severe damage and the payout has moved lower. PLTW's higher headline yield does not override that diagnosis. PLTY's assigned verdict is also on life support. The payout increasingly comes at the expense of capital or is being cut. The same label arrives through a different medical chart. PLTY's distribution-inclusive result is plus 101%, which is the standout achievement in this matchup. Its price and NAV result alone is negative 45%, however, and its latest 4 distribution average is only 9% of the first 4 average. PLTY historically delivered much more value when cash and remaining capital are considered together, but the distribution trend is in far worse condition. The original payout pace did not merely cool down, it became a poor guide to the recent reality. So the decisive conclusion is not that these funds are interchangeable. PLTY has been the stronger historical wealth-producing machine under the supplied simple calculation. PLTW currently carries the higher headline yield and has retained more of its opening distribution average, but it produced the weaker all-in result, the worse NAV path, and the deeper maximum drawdown. The head-to-head winner depends entirely on which examination you are performing. If you are measuring historical distribution-inclusive performance, PLTY leads clearly. If you are measuring preservation of the early payout pace, PLTW looks less impaired. If you are measuring capital stability, neither fund passes as healthy, though PLTY held up better. If you are looking for straightforward ownership of Palantir, neither provides it. PLTW changes the exposure with leverage and weekly targeting, while PLTY changes it by selling calls and capping gains. These are different tools for different goals, not a command to buy either one. PLTW is a leveraged weekly Palantir income vehicle with serious capital damage. PLTY is a synthetic covered call income vehicle with a stronger historical all-in result, but a drastically weakened distribution trend. The correct question is not, which yield is bigger? It is, which trade-off am I actually agreeing to, and does the current fund documentation still show the machine I think I own? That is the income autopsy finding. Both patients remain alive, but neither leaves intensive care. Research only. 2 quick things before you go. If this head-to-head helped you cut through the hype, hit the like button and subscribe. It is what keeps these autopsies coming. And tell us in the comments, which of these 2 would you pick and what matchup should we run next? We read everyone. Thanks for watching.